I'm here with Yuri Milner, the CEO of DST. Yuri has become very well known over the last year in the United States after he invested in first Facebook and then Zynga, as well as some other, some other startups. Yuri, you agreed to talk to me a little bit about some of the stuff you've been doing in the last year. How are you enjoying the conference so far?
Yeah, it's great. This is my first time.
So you invested in Facebook, and I think it was announced in May. Is that right?
Yes.
And that was a fairly unique deal structure in that you purchased primary preferred stock at $10 billion valuation that was announced, and you invested another chunk of money to buy common stock back from shareholders and others who held common stock at $6.5 billion valuation, I believe, was announced, right?
Yeah, something like that.
Something like that. So 65% valuation, something like that. You did something similar with Zynga, and I think at that point, we and others have now started to refer to these as DST deals, even ones where you're not invested in, where you come in, you invest primary dollars in preferred stock, and then you get your dollar cost average of the stock down low by buying common stock off of the employees. Can you tell me a little bit about these deals and how you came up with it and how they've evolved?
Well, basically, I believe that some of the top companies are still early stage. Like Facebook and 10 billion, surprisingly to me, is in sort of early stage investment.
Yeah.
And the reason I'm saying that is that, having analyzed a number of tech IPOs, like in the last 10 years, I kind of see that many companies, from my standpoint, go public too early. And then there is, on average, 25 to 30 times upside left in public markets.
Yeah.
Secondly, some companies just don't have to go public that early, driven by business logic. So my thesis is basically that if you are only driven by liquidity concerns, when you go public, you don't have to. You can basically resort to private sources to solve liquidity issues.
And you can release some of the pressure at the employee level. Yeah.
Exactly. So, and it not always, needs like 30% liquidity to release this pressure. But as it turns out, like 5 to 10% of the liquidity could be enough for these companies kind of to move forward a few years and still, make IPO.
Do you think at this point 65% is about the right price for the common to preferred ratio? Or does it depend on the company? Or?
Yeah, I think as time goes and as companies mature, the spread between commons and preferreds tends to narrow.
Yeah.
And that's why we were sort of pretty much indifferent in what we've been investing in, being preferreds, commons, and all kinds of other instruments.
Yeah.
But, I think that in all these companies that are very successful and that are not really going bankrupt, it sort of really does make a lot of difference.
Which companies have you not invested in yet that you'd really like to add to your? I've said that investing in companies is becoming the bling for Russian entrepreneurs, which is easy to say when the Russian entrepreneurs aren't sitting right in front of me. But are there any startups that you'd really like to add to your collection?
Well,
Yelp, for example.
We tend to be sort of late-stage investments, although I think that some companies at the billions of dollars valuation are still early stage. But I think our universe is something like 50 companies globally, not only in the U.S.
How many of those are based in Russia? Or the former Eastern Bloc?
Probably, less than 5.
Yeah.
And in some of them we're already invested.
Yeah.
But if you're talking globally, and that's sort of what I tend to do recently, is sort of really look globally. I think, this is sort of the universe of companies that would be interested in that kind of deals that we've been doing, in 2009.
Do you think that investing in companies like Facebook and Zynga means that they're going to go public later than they otherwise would have, because they're releasing that pressure at the employee level?
Well, I think so. Yeah. At some level, the founders of these
Yeah.
companies that sort of tend to be driving the development, along with the management. They, in many ways, their message to us was that they really need to focus on product
Yeah.
in their, in a way that would allow them to drive value in the future, and that's that type of deals I think allow them some time to do that before going public.
Did you look at the Yelp deal that is supposedly closing now? Is that a company you would have been interested in investing in, or have you invested in it?
I can't really comment on that.
What about going forward for DST, raising new capital? Are you raising that capital in Russia? Are you raising it in the United States? Are you becoming a...
No, I think for us the logical thing is to raise capital globally,
Yeah.
because we view ourselves as global investors. So I think we need to really be very balanced on the asset side and on the liability side, and
Yeah.
to have like a almost perfect match in terms of having global investors and global investments.
Yeah. So who has more revenue today, Facebook or Zynga?
The reason for us to be able to make these investments is not really to disclose information. So to the
So
extent
you refuse to disclose information.
right.
Yeah. Any other big investments coming?
Well, I hope so, and you will be the
Second
one
or
who will
third to
hear about
know.
it.
Yuri, thanks very much.
Thank you.